Good morning. We are looking at how to prepare a trial balance from the various books we have been designing so far. We started with the three-column cash book. We proceeded to design purchase book. We gave the suppliers account. We came to look at the sales book, the customers accounts. Then recently we had a look at the inventory accounts. So the next is to look at how to prepare a trial balance. So our assumption is that we are preparing trial balance using opening balances. And for opening balances, we expect to have balances for our asset accounts, our liabilities accounts, and our capital accounts. So looking at the trial balance you see here, we only have balances for asset accounts, which is the machinery, motor vehicle, furniture, cash bank, inventory, and the customers. Then we have capital account balance also here. We have loan account and we have suppliers account. So these are the opening balances that we have. Um, Within the X ones, some are control accounts, especially with the inventory, which is 22,350 is a control account, meaning that that balance is made up of the balances for all these individual stock items. The same way, the customer's balance of 13,400 is the sum of all the customer balances, and that of the supplier balance of 8,050 is the sum of the supplier balances. So when you add this up, and then the total is what we transfer into the trial balance. So now we are going to look at our system that we've been designing for some time ago now, and see how we can add the trial balance to it. So that hopefully in the next recording, we shall look at how to prepare the income statement and that of the statement of financial position. So we go and have a look at our accounting system in Excel, which start from the cash book to the purchases to the supplier, sales, customers, and inventory. So now we are going to add a new worksheet which will contain our trial balance. So I click on this and label the sheet as a trial balance. Okay. To set up the trial balance, you know that it has to contain three columns: a column for particulars, a column for debit entries, and a column for credit entries. So while you are opening up the columns, you make sure that at the end you don't end up where the one of the columns will appear in another page. So let me confirm whether I'll have all these three columns on a page. So I go to the page layout and then take this print option under the sheet option. Yes, I even still have enough space, right? So it means that the columns I have opened are okay. All right, so with these three columns, I'll be able to design my trial balance. The trial balance will have to start with the title, and the title include the organization name. So let's say Joy Enterprise. And the title of the report is trial balance. So trial balance as such, then the date. Okay, so I'll center this also. Right. Now, the next is that within the first column, we label that as particulars. Then we have our debit column, and then we have our credit column. Okay. Under particulars, all the various accounts on the file sheet, especially those under the general ledger, all of them will have to be transferred to the trial balance. So I'll copy all these accounts, I'll copy all of them and paste them in my trial balance under the particulars column. Okay. Now, after pasting, I realized that some of the accounts names, some of them are in uppercase, some of them are in lowercase. So let me try to convert all into uppercase. To do this, we use a function called upper, then bracket open. So I pick this one and enter. So I'll drag to get all of them. So now all the accounts are in uppercase. So the next thing to do is that I'll have to copy and then paste them here. So if I copy right now and just paste it, let's see the outcome. Look at what happens. So it means that as I copy, I'll have to do what you call paste special. So when I click below this arrow on this, below the paste on the arrow, you see there is a paste values here. Okay, paste values, and I pick this one. Okay, so at this stage, I can do away with the what do you call it, the second details. Okay, so let me restore my system. So I'll have my debit entry back. Okay, right. So I have my trial balance in place. Now, how do we, okay, I think that there are some other accounts that I did not bring here. There are some other accounts such as the VAT payable account and the NHIL payable. And even in the cash book, we also have a discount allowed and then discount received. Okay, so these accounts also have to appear. All right. Now, how do we transfer these balances? You know, some of them, we have their balances easily within the other sheet we have prepared. For instance, you can have the purchase balance to be transferred from the purchase sheet. We can have the sales balance to be transferred from the sales sheet. Okay. We can have the cash balance to be transferred from the cash book. We can have the customer's balance to be transferred from the customer sheet. Inventory balance to be transferred from the inventory sheet. Suppliers balance to be transferred from the supplier sheet. Okay. Now, all the expenses and other revenue accounts, for instance, rent, wages, insurance, which are all expenses, we will be able to get their balances transferred from the payment side of the cash book, because at any time we pay for any of these expenses, we record them within the payment side of the cash book. So that means that we can easily transfer their balances from there into the trial balance. The revenue accounts such as commission received and the rent received, we can get also from the receipt side of the cash book. So their balances will easily be transferred from there. The cash bank balances are within the cash book. The purchases balances within the purchase book. The sales balance within the sales book. The VAT and the NHIL payables, we can have them from the sales and the purchase book. And the discount allowed and discount received will also be obtained from the receipts sheet and that of the payment sheet, respectively. So, beside this, accounts like non-current assets, including the motor vehicle furniture, motor and the machinery, as well as their accumulated depreciations. All these balances, we can't get them from the existing books here. So what you need to do is that we will have to create another separate sheet to prepare what you call the asset schedule account or the asset schedule. So from the asset schedule, we'll be able to get their balances to be transferred into the trial balance. Okay, so before even we look at how to get their balances transferred, I would like us to look at how these other schedules can be prepared. So the first schedule we are going to prepare will be the asset schedule. Then the same way, capital account balance cannot be obtained from any of the existing books. So it means you have to prepare a schedule for capital account. Then the loan account, you have to prepare schedules for the loan account. And the drawings account, you have to prepare a schedule for the drawings account. So we are going to see how these schedules are prepared so that we can then go ahead and transfer all the various balances into our trial balance. So the first schedule we are going to have is the non-current asset schedule. So non-current assets. Then we also prepare a schedule for capital loan and drawings. So we have a schedule for capital loan and then drawings. Okay, so these are the various schedules that we'll be preparing to be able to design our trial balance. Okay, now From the asset schedule, we will set it up like this. We will have the list of various non-current assets, including motor vehicle. We have furniture. We have machinery. We have the total. All right. So this is our various non-current assets. Now we will indicate their cost. And below cost, we will have opening balance. We will have addition. We will have revaluation. We have disposal. Then we will have the, what do you call it, depreciation side. And under depreciation, there we have opening balance. We will have the charge for the year. We have revaluation. And then we will have disposal. Okay, so this is our asset schedule. Now let's look at the interpretations. You see, at the start of the period, we are to have asset balances. We are to have asset balances just as we have the opening balance for motor vehicle to be 150,000. And then we have the opening balance for furniture to be 50,000. And that of the machinery to be 20,000. Okay. Now, when you place the individual balances, what you have to do is that you sum them up to get the total. So I'll use the shortcut to get the sum. I need to highlight the 3 to the total column and click on my auto sum. This will give me the total. So this one, I have to drag it for all of them. Now, the addition here means that if within the year we are to buy any of the assets, when we buy the asset, we will record the purchase in the payment side of the cash book. So the moment we record the purchase of the asset in the payment side of the cash book, you will expect that the system should transfer it to the non-current asset as addition. The revaluation. Within the year, we can decide to revalue this asset. For instance, as the motor vehicle stands at 150,000, we can decide that, well, we know the value of this is now supposed to be 120,000. So the revaluation amount, we will have to record it here. And how do we do the revaluation? If you value the asset higher, for instance, if you should value it to 170,000, then it means you have to add something to the 150,000 here, so that at the end it will stand at 170,000. So that means that our revaluation will be 20,000. So that by adding the 20,000 to the 150,000, that will give us a balance of 170,000. If we should revalue the asset down to, let's say, 140,000, then we need to enter something that will reduce the 150 to 140,000. That means that we have to make it negative 10,000. So when you put it as negative 10,000, it means this negative 10,000 will be deducted from the 150,000 to give us the new balance of, or the new value of 140,000. So this is how the revaluation on the cost side is recorded. So all the time, if you value the asset higher, the difference is recorded as a positive value. If you value the asset lower, the difference is recorded as a negative value. Then disposal. Within the period, if we are to dispose of any asset, right? Then, for instance, you may have about more than one motor vehicle in place, and the sum of all their balances is what we have at 150,000. So if we are to sell one of them, which cost originally at, let's say, 30,000, then the cost of the asset we are selling will have to be removed from the books, and that one we will have to record it as negative value, so that the cost of the asset we are selling will be taken from the books. Okay, so in brief, this is how the the cost section is looked at. But with the addition, we need to link it to the cash book so that at any time we buy any of the assets, the system will sum them up and then transfer the total here. You know, it's likely we can buy more than one motor vehicle within the year. So that means that if you to buy more than one motor vehicle within the year, all of them will appear in the payment side of the cash book. So we expect that the system should sum up all the motor vehicle purchased, their cost from the cash book into the trial balance. And this will require us to apply the sum if function. So we are going to apply the sum if function to be able to transfer the sum of all asset purchased from the cash book into the asset schedule. And in this case, the particulars will be our range, the gross amount will be our sum range. So going back to the non-current asset schedule, under addition, we say that sum if. Now we pick it from the payment table. The column serving as a range is the particulars, comma. Our criteria is this asset, this asset which is in B1, comma, and then we will have our sum range to come from the payment side again, and then the column is the gross amount. The column is the gross amount. Okay, we close the square bracket before this. Now, when you get this, you know, because they are in a row, you cannot drag, because if you drag, the range will change. It will no more be particulars and it will no more be gross amount. Let us try it and see. If I should drag it to this place, you see that now the range has become reference and this has become discount rate. So it means you cannot drag. But what you can do is that you copy this formula and then you come and paste it here. Let us see what will happen. So if you copy and paste, that one you'll be able to get it right, okay? Then you will still have to copy and paste it for that of the machinery. Okay, so this has given us the sum of all asset purchased being transferred from the payment side into the asset schedule. So now we sum out these three values. We sum from the opening balance to the disposal, and you get your total here. So this one can be dragged. I'll need to underline this. Okay, so when I go to the chart for the year, I mean the depreciation column, over there too, we had the opening balances for the depreciation in the trial balance. We had the opening balances for depreciation in the trial balance. Let me see whether we have them. When you go to the trial balance, fortunately, we don't have the opening balances for depreciation. So it means that the assets were not depreciated previously. So we don't have anything like that. Now let me explain this side. If there's opening balance for depreciation, then we will record the opening balances for depreciation also here. Charge for the year. You compute the depreciation charge for the year and you record that also here. For revaluation, when an asset is revalued, what we do is that we will transfer the accumulated depreciation of the revalued asset to what you call revaluation surplus account. So far, at the time the asset is revalued, you have to ascertain the accumulated depreciation on it. And this accumulated depreciation will have to be recorded as a negative value at the revaluation side here, so that you transfer that to what you call revaluation surplus account. Revaluation surplus account. Then for disposal, when an asset is sold, then we transfer the sum or the cost of the asset we are selling, we transfer it from the books. So in that case, you record the cost of the asset sold to this side. All right, so at the end of the day, we will sum up the depreciation side. We sum up the depreciation side, which include the opening balance to the disposal. And that too will have to be here. Then we drag. This also will have to be underlined. So that at the end, we will be able to compute the balance. And the balance is going to be the total for the cost minus the total for the depreciation. Then we get this balance. We transfer, we close it here. The closing balances are transferred to what you call the balance sheet or the statement of financial position. Now, when you are transferring them to the trial balance, this is what we do. In transfer to the trial balance, as far as the cost is concerned, we can pick the total on the cost column and transfer it to the trial balance. Then that of the depreciation, we will transfer the opening balance into the trial balance. We will transfer the opening balance into the trial balance. Okay, so we will transfer the opening balance of depreciation into the trial balance, while we transfer the total for the cost column into the trial balance for the asset account. Now, the capital loan and the drawing schedule, here also we have capital account, we have loan, which is the bank loan, we have drawings. Okay, so this one, we cannot take the total, so there should be no total for it because they are separate accounts. Then at the start of the period, we will show the opening balance. Then we have addition. Okay, then we will have some payment or reduction. Okay, so in the trial balance, or in this particular case study, we have balances for our capital to be 100,000. So capital is 100,000. Capital balance is 100,000. The loan is 150,000. There's no balance for the drawings. Now the addition here means that if we decide to introduce additional capital, then we will expect that the additional capital we introduce should be added up to the opening balance. And in this case, if additional capital comes, we record that additional capital into the receipt side. So we record additional capital into the receipt side. So what you can do is that we will use the sum if function to be able to transfer additional capital from the cash book to this side. So sum if, this time from the receipt table, and the range will be the particulars. Criteria will be capital accounts, and then the sum range from the receipt table, and the column is the gross amount. All right, so this will enable us to transfer any additional capital from the cash book to the capital account. Right, we do have to also transfer any additional loan into the loan account. So with this, we'll copy this on. Additional loan will also come from the cash book. Okay, now if there is drawings and the drawings will go through the cash book, then the drawings will have to be on the payment side. So the drawings will be transferred from the payment side, particulars. Then pick this as a criteria, and the sum range is also the gross amount from the payment table. Okay, all right. Now, for reduction, okay, before that, we will sum up these two. We will sum up the two. So I can underline this and get your total down. Okay, then we will have their payment or reduction if capital is reduced or loan is paid. Okay, then we will also transfer from the cash book. If we reduce capital or pay loan, all will go to the payment side of the cash book, right? So in this case, the sum if function will come, payment, and the column is the particulars column. Criteria becomes this one again. And the sum range from the payment table. And that is the gross amount. Okay, so when the capital is reduced, it could go to the cash book and therefore we transfer to this side. When we pay for a loan, payment of loan also goes to the payment side of the cash book. That also comes here. As far as the drawings is concerned, mostly we don't have something like that. So at the end, we'll be able to calculate the closing balance. So the closing balance of capital becomes this minus the addition, the payment or reduction. Okay. Now, transferring to the trial balance, we expect to transfer the closing balance. So it's the closing balance that we'll be transferring. So in this case, these balances will have to be transferred into the trial balance. So having done all this, we can then move on to look at how the trial balance is going to be prepared. So we go into the trial balance. When you come here, all asset accounts, all expenses accounts rather, all expenses, including the rent, wages, insurance, we get the totals from the cash book. Whenever we pay for an expense, we record it in the payment side of the cash book. So if you want to know the total rent paid so far, you go to the payment side of the cash book and sum up all payment of rent. And this total will have to be transferred to the debit side of the trial balance. So we need to use the sum if function. The table is the payment because we pay for these expenses, and the column becomes the particulars column. So the particulars column and the criteria will be this rent, comma, the sum range also from the payment table, and the column will be the gross amount. The column will be the gross amount. So this is how we will be able to transfer all payment of rent from the payment side of the cash book into our trial balance. So when we are done, we accept this. Okay, let me format these columns also. Now, this formula I have entered for rent, I can copy it for the other expenses up to insurance. For commission received and rent received, they will be recorded in the receipt side of the cash book. So I need to link it there so that I'll be able to sum all of them up. So this is going to be equal to sum if receipt. From the receipt table, particulars will be the range, comma, my criteria will be this commission received, which is in A7, comma, and from the receipt table once again, the gross amount will be the sum range. So I'll get my commission received. Then I can drag this to the rent received to transfer that as well. For cash balance is calculated in the cash book. So I will just copy it and paste here. And this one, we use the equal sign. So I'll put down the equal sign in front of cash. Then go and locate the cash book. From the cash book, maybe from the receipt side, this is the cash balance. So I pick this and enter. I have my bank balance also calculated. So equal to, I go to the cash book once again. I go to the cash book and this is my bank balance. I pick this also. Capital account, we have worked on it within the capital and loan schedule. So capital account, I type equal sign here and move on to the capital and loan schedule. And I pick my closing balance of capital, this one. No, capital account is supposed to be on the credit, so I take this to the credit side. The motor vehicle as an asset, I'll pick the balance from the asset schedule. So on the debit side, equal to, go to non-current asset schedule, and I'll pick this one, the cost. Total cost for motor vehicle, I enter. Furniture is also going to come from the, what do you call it, the asset schedule. So equal to, go to my non-current asset schedule, furniture, this is the cost. I pick this one and I enter. Purchases. The purchases balance is calculated already within the purchase book. So as the balance is already calculated, I'll just use the equal sign, go into the purchase book, and when I go, this is the purchases. This is the purchases balance. I pick that one, and then I enter. Drawings balance is calculated within the capital loan drawing schedule. So I put the equal sign here and locate my drawings account, and this is the balance. So this is my drawings balance. Sales on the credit side is also calculated within the sales sheet. So equal to, I go to my sales sheet, and this is my sales account. So I select this and then I enter. The accumulated depreciation for vehicle is also within the non-current asset. So on the credit side, equal to, I go to non-current asset, and this time I'll pick the opening balance for the depreciation. So the opening balance is in cell B10. So I pick this one and I enter. That of the furniture, I do the same thing. I go to non-current asset and pick the opening balance for depreciation for furniture. Machinery account on the debit side will come from the non-current asset. So equal to non-current asset, and I pick the machinery balance, which is here. I accept it. The depreciation will also come from the non-current on the credit. I go to the non-current asset, and the depreciation, I pick the opening balance. No, I mistakenly picked the total. So let me restart. Equal to the machinery depreciation is in D. So I pick that one. The loan account, I have the schedule for the loan account. So I'll put the loan on the credit side equal to, then go to the loan schedule, or the loan account. Loan balance is this one, the closing balance. I accept that one. Okay. VAT payable, NHI payable, and the remaining control accounts. All these we are going to transfer from their respective books. The VAT payable and the NHIL, we get them from the sales and the purchases. When you go into the purchases sheet, we have VAT there. When you go to the sales, we have VAT there. So which of them constitute the VAT payable? VAT payable is the difference between sales VAT and purchase VAT. So the difference between the sales VAT and the purchase VAT is called the VAT payable. This concept, I believe you've learned this a lot in your taxation course. When you go and buy and you pay VAT on it for, let's say, 10, and then you sell the product, you collect VAT of, let's say, 12. It means you are liable to pay government 2 out of the 12 you collected, because you paid for 10 already, and now you've collected what? 12. So the difference between the VAT on sales and VAT on purchases is what you call the VAT payable. So to get this one, on the VAT payable, which is a credit, you type equal sign, you go to the sales side first. So when you go to the sales, you select the VAT on sales, then minus, then go to the purchases to select the VAT on purchases. So VAT on sales minus VAT on purchases gives the VAT payable. The NHI payable, that also, we have it from that is also going to be VAT on sales, NHIL on sales minus NHIL on purchases. So NHIL on sales, we pick that from the sales table minus NHIL on purchases from the purchases table. So that will give us the value for the NHIL. Discount allowed, suppose we on the debit side, we have this balance already computed in the cash book at the receipt side. So equal to, we go to the receipt side of our cash book, and discount allowed is here. We pick this balance, we enter. Discount received, which is supposed to be a credit, is on the payment side of the cash book. So we go to the payment side of the cash book, and this is the discount received. Okay. Right. There are some other control accounts. We did not state them. Accounts payable. accounts receivable, and then inventory. Right. So accounts payable is the sum of all individual supplier balances. Supplier balances are within the suppliers table. So here we have created a suppliers table, and this table is labeled as supplier. So when you sum up their closing balances, that gives us the accounts payable to be shown on the credit side. So we have equal to sum. The table is called supplier. The column we are to sum up is the closing balance. So the closing balance from the supplier table will give us the accounts payable. Then the customer table also is there. So when you sum out the closing balances from the customer table, that will also give us the accounts receivable. So the sum of the customer balances within the customer table. So the closing balances here will give us the accounts receivable. With the inventory, when you come to the inventory table, this is how I have set it up. You see, we have the description containing the items, the opening quantity, the unit cost, the opening amount, purchase quantity, sales quantity, closing quantity, then we have closing amount. So we sum up the balances from the closing amount. So we sum up all the balances on the closing amount. Okay, in a trial balance, for inventory, it is rather the opening amount for inventory that appears in a trial balance. It is the opening stock that we show in a trial balance. The closing one will appear in the trading account. So over here, we will have to sum up the opening amount into the trial balance. So here we say that sum of opening amount from the inventory table. So the inventory table, we pick it here, and the column to add constitute the opening amount. So we add up the opening amount from the inventory. And this completes our trial balance. So at the end of it all, we will have to compute the totals. So we sum up all the balances on the debit. So I can highlight all the debit column up to this next empty line and use the auto sum, right? So this will give me the totals. The totals is here. Let me underline this. To be able to underline this, I have to put 0 there. Then I underline this one. Okay, so that I can drag this to this side. I will need double line to complete my trial balance. Someone will say that the trial balance does not agree. Note, because we have not recorded all the balances. We only recorded balances for the assets and the capital accounts as well as the loan. So now, going back to the work to record the balances, you see that we had the bank balance to be 1,008, cash balance to be 500. So let me go into the cash book on the receipt side. Let's assume January 1st, 2020. I'll pick my OB here, and I'll pick balance. So, this one, the 500 is cash. So for me to show the balance on the cash, let me pick my cash here so that the balance 500 goes to the cash column. On the same date, I record the balance for that of the bank, which is 1,008. And this will have to go to the bank column. So I pick my check so that it can go to the bank column. So I have recorded the cash and the bank balance. There is also a balance for, so all the remaining balances are control account. So when I go to the suppliers, let me go to the suppliers. The supplier balance is there. Okay, so I have some list of suppliers which are not here. So let me go to the file sheet to add them. The question gave us list of suppliers, including Adom Enterprise. So let me say that, okay, I can replace some of these names. So Adom Enterprise. We have Asempa Limited. We have Unity Company Limited. Then we have Unia Limited. The same way that the customers, some of them are not there. So let me replace them here. I have Iron Boy Limited. I have Two Brothers. I have Sonny. I have Danny. And I have James. Okay, so having entered my customers and suppliers, I can record their balances. So the opening balance for Adom is 750. Opening balance for Asempa 2005, 1008, and 3000. So when I go to the customer side, their opening balance is Iron Boy 5000. I have 2005 for Two Brothers, 1005 for Sunny, 3006, and 800. Then I also have opening balances for my inventory items. So when I open the inventory, then I'll be able to tell their quantities. We have 50, 60, 40. We have 20, 200, 20, 15, 50, 50, 65, 55, 30, 32, and then 18. Then their unit cost 5, 7, 2, 3, 15, 60, 60, 70, 40, 60 is there, 40 here, 55, 80, and then 35. So right after recording all these balances, let us check the trial balance. You come and see the trial balance as agreed, right? Good. So we have our trial balance in place. So at this stage, any additional transaction you record, it will update your trial balance. Let us see. For instance, if we make a sale, if you are to sell on the 2nd of January 2020, we are making some sales. So if you sell to any of the customers, let's say Iron Boy, pick our sales here. We sell some categories, some let's say stationery item. It's a book. The quantity we sell is, let's say, 200. Let's suppose we choose the VAT, standard VAT. Let's go and check from our trial balance. We come and see that now, based on the sales we recorded, we had VAT payable and any child payable here. Now, we expect to get the balance for sales, which is also here. Okay. Then we also expect that the accounts receivable balance will change because of the sales. So now you see the trial balance has changed. The balance has changed. Okay. Okay. If we are to pay for an expense, let's go and pay for an expense in cash. No, initially cash balance is 500. If you could remember that. Now you're going to pay for an expense, let's say on the 3rd of January 2020. We choose general ledger account. We pay for rent. Let's assume we pay for rent of 100. Initially cash balance was 500. So paying for rent of 100, let's see the outcome. We pay in cash. Now you see the cash balance has become 400. Let us go and see. When you go into the trial balance, you go and see that cash balance is now 400. And now there is a balance for rent, which is 100. Okay. Now our trial balance has agreed. So having prepared your trial balance at this stage, the subsequent entries you'll be recording, you will be able to get all of them here. The only problem is that if you introduce a new account, then you have to come and insert the account in the trial balance and then come out with the correct way you can get the balance to be transferred. If it is a non-current asset, then the account in that new account will have to be added also onto the non-current asset schedule before you show the same new account into the trial balance. So this is basically how the trial balance is prepared. God willing, in our next recording, we shall look at how to prepare the income statement from this trial balance. Then from there, we can also have a look at how to prepare the statement of financial position. Okay, thank you very much.